Hello, my name is Jasmine and today I will be talking to you about Treasury bonds. Treasury bonds are a type of fixed-rate government debt security with a maturity of either 20 or 30 years.
Jasmine, I was hoping to diversify my investments and would like to learn more about Treasury bonds. What are Treasury bonds and how do I buy them?
Treasury bonds pay a fixed rate of interest semi-annually until they mature. Investors can buy Treasury bonds directly through electronic auctions or on the secondary market. Treasury bonds are an important source of funding for the U.S. government as they help government finance operations and meet debt obligations. You can hold a bond until it matures or sell it before it matures.
Jasmine, I've been hearing a lot about Treasury bonds and they sound too good to be true. Is it true that Treasury bonds are a low-risk investment? Am I guaranteed to not lose money?
Yes, Treasury bonds are considered a low-risk investment. This is largely because they are issued and backed by the U.S. government and are risk-free when held to maturity. In other words, investors that hold the bond until maturity are guaranteed their principal or initial investment. Treasury bonds are free of default risk largely because the U.S. government can simply print new dollars to pay for maturing bonds. However, interest rate increases, due to inflation, can cause the price of a bond to decrease.
Jasmine, I had one last question for you before we head to lunch. Why does the government issue Treasury bonds?
Okay, but this better be the last question. I'm starving. The Treasury Department determines how much and when to issue Treasury bond based on several factors such as the government's budget deficit, level of interest rates, and demand for Treasury bonds. The Treasury Department wants to issue bonds when there is a lot of demand and when interest rates are relatively low. The Treasury also needs to issue bonds to finance the government's budget deficit. A budget deficit occurs when the government spends more than its revenue and needs to borrow money from the public and other entities. The larger the deficit, the more bonds that need to be issued.